What exactly is trusted investing?
Trusted investing is a passive way to make your money work for you. Is the simplest way to look at it. You're essentially letting someone else borrow money, and they're going to pay you payments on that money. And when the loan pays off, you get your entire principal back. Think of it like dividends on steroids. People who obsess over dividend stocks because they get those dividends paid out. Trusted investing, you get monthly payments. You get a check each month from the borrower when they make that payment, and you're earning that money. It's regular income that comes into your bank account.
So what is growth strategy you guys have?
So if I'm looking at growth, I'm saying, okay, number one is licensing and compliance. What states can we lend in with the licensing we have, or what licensing do I need in order to do so? Once I've identified those markets and I can lend there, but is there really a desire from the investor standpoint? The growth aspect really became understanding what investors were looking for and what borrowers needed, and then really putting those two things together.
How to manage the relationship with the clients?
Offering the best service possible is really what it comes down to. Put a good taste in their mouth. Like when they're done talking to you, make sure that they walk away from that conversation happy.
First of all, welcome.
Thank you.
Let us know who you are and what you do. What is your story?
Yeah, my name is Jeff LaMotte. I'm president of Val-Chris Investments. We are a private money lending firm based out of Irvine, California. I've been at the firm since 2009, and at that time I was at UC Irvine as a college student, and I started working there part-time, and I've been there ever since.
And so you mentioned about that you were studying history at school, and now you're in finance industry.
Yeah, so I was initially a history major. My full intention was going to be a history professor or an attorney. That was kind of what I always wanted to do. I needed a job in college, and so I started working at Val-Chris part-time there. It was a family company, and on my now wife's side. And I just took to it, and I loved it. And so I ended up staying there, and I have a degree in history, yet I work in finance. So.
And what part of finance interests you the most, or what part of finance excites you the most?
I would say it's exciting to be able to see the power of growth when it comes to money in general, right? It's you go to school and you earn money and you eventually want to retire. The idea being that you retire when you're older, 65 years old, whatever it is. The idea with finance, though, is you can grow that money without actually having to constantly work for it. You know, if you invest your money properly, you can see that exponential growth essentially over time. And I think that is the most exciting part. It's something that you don't learn unless you try and learn it, and a lot of people don't try and learn it. And so being in finance, you get that aspect, and it's a good real life lesson, and you fully understand kind of compounding interest and how it functions.
Compounding interest.
Yeah, and I think that's an exciting thing personally. That's something that gets me going, and it's cool to talk about and educate people. And once you see it finally switch in their brain, and they start to realize that they don't always need to work for their money, but sometimes their money can work for them, it's a cool thing to see.
You graduated from school learning history, but then you pivot to finance. So before you took this job, did you learn finance in school, or you went straight into the job? No,
I just went straight into the job, and I learned kind of on the fly. I did a lot of basic work for a couple of years to kind of fully understand it. And then from there, I got my license and just really dove in, and it became kind of my passion, and I still enjoy it to this day, frankly.
Was it hard for you to learn finances within a job? Because I know a lot of people say finance is hard because it's about numbers and a lot of concepts, a lot of terms. Was it hard for you?
I would say the terminology is something that everyone needs to learn. You know, regardless of whatever field you're going into, everything has its own specific set of guidelines, terms, and stuff you need to understand, right?
Yes.
And this was no different. Now, there's different levels of finance. There's stock markets. There's equipment rentals. There's real estate investing. Whatever it is. Ours is a weird, specific kind of niche industry that a lot of people don't know about. Thankfully, I picked up on it, and it just became natural to me, and it just makes sense. It's one of those more common sense type of investments or finance, if you will, at least to me. And so for me, it was natural, and I took to it pretty quickly.
Nice.
Yeah.
And a lot of people have this conception that if you can't get into a really, really good school, then you can't find a good job in finance market, in investment banking. Is that a misconception? Because by your story, it seems like it's different.
Yeah, I mean, like I said, I went to UCI, so I think it's a top 40 school. It's a good school.
Yes.
My partner went to USC, but then everyone else in our company, I don't know if really anyone else went to school as far as like sales staff and things like that.
Yeah.
So it is a misconception, in my opinion. I think we lose a lot of good talent to very high student loans and other things that I'm sure it could be a whole nother podcast episode. But some of the smartest people I've seen don't have a college education, but they're phenomenal at what they do. And so, yeah, I would agree. I don't think it's a requirement to be successful at what you do, depending on the field. Obviously, if you're going to be a doctor, you probably need to go. You probably want to go to a good school. But considering where I'm at and where a lot of our staff is at, and a lot of our sales guys who are phenomenal at what they do, no, I don't think it's required. It's a required thing.
Nice.
Yeah.
And you started as a part-time job, and now you're the president of Val-Chris Investment. How did that happen? What was the process?
A long process, many years of figuring out the industry, getting my name out there, helping the company grow, and really just showing a complete understanding of the business as a whole. I was never going to be a business major. I was never going to be, my plan was never to go into business. And so for me, it was quite the pivot. So I really had to learn a full new process, industry, everything. And it took time. It took a while to figure out. And if anyone tells you they take to this stuff easily, they're lying to you. It's kind of like, when you go to college, it's not to show how smart you are, but it's really to make sure you can get through it, in my opinion. Can you get through the years to get to graduation and all that? And it's similar to this. I basically just said, screw it. I was able to get through that. Why can't I do this? And I spent a lot of time studying. I got a lot of licensing, and over time I figured it out. And I think that, coupled with understanding growth and helping the company to grow, and being pretty good at the sales aspect and understanding the different sides of it, is really kind of where it got me today.
Got you. And so let's switch gears a little bit and talk about trusted investing, because this is actually the main part of this conversation today.
Yeah.
So for listeners who are new to this idea, what exactly is trusted investing?
Yeah, so the easiest way to think about it, if you are a trusted investor, consider yourself like a bank. So if someone wants to go buy a house, they're going to go to the bank and they're going to say, I want to get a mortgage to buy a home. And then when you buy that home, that mortgage goes on the property and you make payments to that bank. Similar to trusted investing, think of yourself as the bank. So what happens is, so I'll use us as an example, Val-Chris Investments. We're what you consider a private money lender. So someone comes to us and they say, hey, I want to borrow some cash to buy a property, like a rental, or I need cash out of my property to inject capital into my business, things like that. We say, okay, your property is worth, say, $1 million. We'll lend you $500,000 or $600,000 of that. And then what happens is we drop the loan documents, we prep the terms, we get an appraisal on the property, we vet the deal, and then we put it out to our investors. And our investors will actually lend that money. So it might be one person who invests the entire loan of $500,000 or $600,000. It could also be, 10 different people at 10% each type thing, as far as ownership goes. And then that money is then given to the borrower. That borrower then makes payments to us as the servicing agent, and then we give those funds to our investors. Typical returns are anywhere from 9 to 12 or 13%, depending on the deal. And there's benefits on both sides. And so our rates are going to be higher. And so the investors will realize those rates, because rather than looking at the borrower and saying, okay, I'm going to go ahead and tiers of tax returns or bank statements, things like that, we're looking at the equity in the property. We're saying, does this loan make sense? Is it, does it have common sense underwriting, as I like to say? If you're borrowing $500,000 on a property worth $1 million, odds are it's a pretty safe investment. I don't want to use the word safe because nothing, no investment is ever perfectly safe, but at the end of the day, that's the way a lot of people will look at it. And then essentially we act as the middleman, collecting the payments, paying them to the investor until that loan pays off.
Thank you. That was a detailed explanation, but if you would explain this in the simplest way to the audience, how, let's say as if you're explaining this to a 10-year-old kid, how would you say what is trusted investing?
Trusted investing is a passive way to make your money work for you, is the simplest way to look at it. You're essentially letting someone else borrow money, and they're going to pay you payments on that money. And when the loan pays off, you get your entire principal back.
So there's borrowers, there's lenders, and there's you guys.
Correct.
And who is providing the real estate as a backup to the loan? Is the borrower or?
Yeah. So when it comes to the real estate itself, it's the borrower that owns it. So the borrower. That is the collateral, right? So if we're going to give someone a loan, we're going to say you need collateral in order to get that loan. And then when we have our investor is providing the capital in order to fund that loan. We do it sometimes depending on the deal, but for the most part, all of our loans are sold off to private investors who are then funding those loans and then retaining that interest essentially.
Sure. And is Val-Chris Investment kind of like a go-between between the borrower and the lender, making sure that both parties are legit?
Correct. Yeah.
I see.
We have our investors. We have a database of a couple thousand private investors, individuals like you and like me. Not huge companies that are funding all these deals like a bank, but individuals with self-directed retirement accounts, with cash accounts, with family trust money, things like that.
Yeah.
And they're looking to diversify. They already have money in the stock market. They already have money in real estate. This is kind of another way for them by buying what you call trust deeds or notes on properties. You can get that extra passive income and diversify your portfolio even more.
And I think so. Real estate is involved in this process. Like, why is real estate? Why isn't other kind of investment to back up the loan?
Well, I mean, trust deed is a function, is an instrument of getting a loan on a property. It's what gets recorded on title to show that loan has been given to that borrower and secured by that property itself. Yeah. In my opinion, I think real estate is one of the
safest.
Yeah, I mean, I would never say safe in investments, but in my opinion, it's one of the better, I would say, securities for your investment. And there's all sorts of loans you can do, and out there as far as investments go. You can invest money in the stock market. You can invest money in unsecured liens, all sorts of different stuff. And specifically, though, our niche at Val-Chris Investments is a real estate-based lending platform.
So from the borrower's perspective, how is it different? How is trustee investing different than traditional banking?
Yeah. Typically, it's quicker but more expensive. And when borrower is looking at getting a private money loan, it's usually for speed. It's usually because they need the money now to buy a rental, whether it's a short sale or they are an investor and they just want to buy, and they're buying multiple properties. So this way they can buy it quickly. But they're looking to close fast, and they're using the equity in the property as the collateral rather than dealing with 2 years tax returns, bank statements, all that kind of stuff that a bank would typically need. Yeah. So they're looking for quick cash for the most part.
So they're like time sensitive, right?
Very time sensitive, yeah. Most private money deals or hard money loans close within about 10 days.
Wow.
Yeah. Versus a bank, like I said, is 60 to 90.
So what is the trade-off if the borrower choose to borrow money from trusted investing instead of traditional banking?
Right. So, sorry, the reason I say that is you would say getting a traditional loan from a bank or getting a hard money loan.
Get a traditional loan from the bank.
Yeah, exactly. Okay, so if you're getting a traditional loan from a bank versus going and getting like a hard money loan or a private money loan, as they call it sometimes too, you're really getting a higher interest rate with private money, but you're getting the money much faster. You're not having to offer as much documentation, and you're using the collateral in the property rather than looking at really your personal finances, right? Like you're not saying, here's my income and tax returns. You're saying, I have a property. I only need half of what it's worth. It makes sense on paper. There's plenty of collateral there. And then that's kind of what we're looking at. So the trade-off really for them is it's quicker money, but it's more expensive. Less requirements, but it's more expensive. And so that's the way they kind of look at it is, okay, yeah, I need this money fast. I want it quickly because I'm going to make money down the line, whether it's, injecting capital in their business or if it's buying a rental property they'll make money on later. To them, it makes sense for that trade-off because they're going to make far more than they will on the more expensive money that they're borrowing essentially in this situation.
So I would say trustee investing is more efficient, but it can be more expensive.
Yeah, for the borrower, it's more efficient, but it's more expensive. It's typically a shorter-term solution to whatever it is. So like I said, I think our average payoff on a loan is roughly 18 months. That's how long the borrower is going to have it. In that time period, they're usually refinancing, they're selling the property, they're doing whatever they need to do to pay the thing off. Our terms are usually about 3 years long, so it's not a long-term solution. They call them short-term financing or bridge loans, and it's typically for those short-term solutions.
And how much interest the borrower is paying on average?
Yeah, it's anywhere between I think our rates start right now around 8.5%, all the way up to 12-13%, depending on the deal.
Depending on the deal.
Yeah.
Gotcha.
I mean, it drastically changes depending on the loan of value they're borrowing at, or the parameters of the deal itself, and also the collateral type, whether it's commercial, residential, land, things like that.
Got you. And now from the investor's perspective, how is trusted investing different than traditional investment? Like, for example, SP 500 index fund, it is passive as well, right? How is trusted investing different than those kind of tradition, investment?
Yeah, so I mean, the market can fluctuate, right? And there's not much
Yes.
collateral there, in my opinion. If you invest in the market, then it swings up and down depending on.
It's so volatile.
It's very volatile. It could be great. And don't get me wrong. I mean, everyone has money in the market. This isn't to replace that. And this isn't something that I ever recommend to replace traditional investing. This is essentially another avenue to invest in. You diversify. That's what you do. And
Yep,
if you
diversify.
diversify properly, that means you have your money in different areas. And I think trusted investing is a solid choice to diversify an investment portfolio. I would never recommend putting all your money into one investment vehicle.
One
right?
basket. No.
Yeah, never do that. And so this wouldn't replace it. This would benefit from everything. And the difference is going to be that monthly passive income. Think of it like dividends on steroids. People who obsess over dividend stocks because they get those dividends paid out. Trusted investing, you get monthly payments. You get a check each month from the borrower when they make that payment, and you're earning that money. It's regular income that comes into your bank account. Mm-hmm. So if you invest for round numbers, $1 million at 12%, you're getting $10,000 a month on your money. Your $1 million is still sitting there.
That's a lot.
Yeah, and and then when the loan pays off, you get that money back.
Yeah. Wow. So what is the historical average return on the investor side so far?
I mean, as far as historical return, it's hard to say because every deal is so different. But I would say on average, if you had to pick, probably 10 to 11%.
Mm-hmm. So is trusted investing like a fixed income type of investment? Because you're saying that the investor is getting paid monthly.
Yeah.
Right?
Yeah. So the rate is fixed.
The rate is fixed.
So the interest in which the borrower is paying and then the investor is receiving is fixed. So at the beginning of the loan will be 8, 9, 10, 11%, whatever it is. That's the term. That's the rate on the loan until the loan matures in 2 to 3 years, however long the term is.
Mm-hmm. And just in terms of diversification, so if I invest in stock market, of course, the risk is higher and the return is higher. Like it's relative, it's balanced. And when it comes to bonds, although the return is not as high as stock, but it's safe. So you always looking for the benefits for this specific diversification. So for trusted investing, what is the biggest benefits that the investor can get from it?
I would say steady income is probably
income.
one of the more, steady passive income, I should say, is really the main benefit of trusted investing. Mm-hmm. That, and when it comes to the diversification side, if you have money in the market, again, there's not really collateral there other than the company itself that you're buying stock in. Mm-hmm. One Twitter post from someone that's famous can send that stock into, exactly, can send it up or down, whatever it might be. Yes. Real estate values, while they do fluctuate, are a little more steady for the most part historically. And so having investments that are backed by real estate, in my opinion, is a good add-on to your current investment portfolio. Mm-hmm. Because like you said, stocks typically have a pretty good return, but I mean, the 40-year average is 7% if you look at most index funds. So yes. That over time, while it's a good return, technically it is lower than trusted investing. If you look at a shorter term, maybe just after COVID, you're going to see a much higher return on your money in the market. But again, trusted investing kind of stays relatively stagnant between that 8 and 12%. So it's a good vehicle, I think, if you're looking to park money outside of the typical investment portfolios that you see that the average person is kind of exposed to, while still retaining a lot of collateral that I think is relatively stable, and to still earn that passive income.
Sure. So we talk about the term passive a lot of times, mm-hmm. and I'm just assuming that most of the audience don't understand this term. So how would you define a passive investment?
I would say a passive investment is when your money is working for you, is the easiest way of kind of putting it. If you're not having to wake up and go to work in order to earn that money, I would consider it passive. I think the term back in the day was mailbox money is what they called it, because investors would walk out to their mailbox and they'd collect their interest checks that they received and they'd go sit back down. Well, now it's all digital. It's ACH, gets directly posited into your account. But I think that's the goal is enough passive income to offset your monthly liabilities. And once you can do that, you can truly be free from whatever it is you want to do, and you can focus on kind of your passions and your goals. I I truly don't think someone is wealthy until they hit that level to where their investments offset what they spend each month. You can make $1 million a year, but if you spend $1.1 million, you're still not making enough money, right?
Yeah,
so,
but like lifestyle inflation always exists. Like
of course,
yeah, I know. And what are some downside of trustee investing?
Yeah, there's downsides to every investment, right? And I would say downsides of trusted investing are major market fluctuations. Look at the 07-08 crash. A property could be worth $1 million today, and then a year from now, maybe it's worth $500,000. And so your investment now isn't as secure as it was at the time that the loan was originated. Typically, when we're lending on properties, we're looking at the overall value, and we'll lend up to roughly 60% of the value. So if a property is worth $1 million, we might lend them up to $600,000. The idea being that $400,000 is what you call an equity cushion, and that's kind of the security in the loan. Obviously, if the value drops drastically and you lose that equity cushion, now at that point, the loan could be the property could be upside down, meaning what's owed on it is more than the value. While it is rare, things like that have occurred. And then at that point, hopefully the borrower keeps making payments. If not, then you need to foreclose, and then you take that property back. And now you own that property as what you call an REO, or real estate owned. And then at that point, you sell it, you use it as a rental, and then maybe you sell it in the future, what have you. It just depends on kind of your own personal prerogative at that point once you own that property. But really the downside is if that happens, or if the borrower isn't making payments, and at that point the interest is just accruing on the balance of what's owed, and then you have to foreclose on the property later down the line, something like that, to try and get your actual loan amount back. Which it happens. It's part of the business. It's the ugly side of the business. But at the end of the day, if an investor lends out money, the idea is that money gets paid back, and that's why the collateral is there.
So from my perspective, I feel like there are kind of two risks. So the first one is there's like market fluctuation on the value of the collateral, and sometimes it can be the real estate. And if the market is going down, then the value of the collateral goes down as well. So that is one part of the risk. And the other part is if the borrower is not paying back. Am I right? Yeah.
And again, if the borrower is not making payments, which happens, each month their payment that's due just gets added to the balance that's owed to the investor. So at the end of the day, if you lend $100,000 and the borrower is making a payment of $1,000 a month for round numbers, and they're making payments on time like clockwork on the first of every month, and then one day they stop making payments, that $1,000 that they should be paying is still added to the balance. So it's not like that investor won't receive that money in the future. It's just it gets added to the balance so that when that property when they do pay off the loan, or when they sell the property, whatever it is, they just owe all of it at one time.
I see.
Yeah.
And if defaults happen, have it happened before?
Yeah, of course.
Like, how do you deal with it? What are like the process like?
Well, we have a full servicing department in our office. So the investor, while we're the servicer and they can make the final decisions, we basically say, okay, the borrower hasn't made payments in 30, 60, 90 days, whatever. We recommend filing what's called a notice of default, which basically is a public filing, putting it on record that there's a default on the property. It starts a 90-day period where the borrower has 90 days to reinstate the loan, meaning to bring it current, and then we can rescind that notice of default. After 90 days, if they don't do that, then we can file for publication, which in the state of California typically means another 21 to 25 days where you can set a sale date. And at that point, the property goes to auction, kind of like what you see in Flip or Flop or some of those HGTV shows where they go buy properties at auction. Those are properties that were being foreclosed on typically. And so that's what's happening is it goes to a legitimate auction, investors bid on the property, and it goes from there.
But those kind of properties sell sometimes really cheap, right?
Yeah, but the investor that's foreclosing, so say, like, again, you have a loan for $500,000 on a property worth $1 million at the time, and you go to sale on it. You're going to start your bid. You're going to start the bidding process at whatever you're owed. So if you're owed $500,000 plus 12 months of interest payments, then you're going to start the minimum bid will be that amount.
Yeah.
Now, if no one bids that amount, that's when it becomes an REO, and it reverts back to our lender. And then that's when the lender can, rent it, use it as a rental, sell it if they want, whatever they want to do on the regular market. They own that property now for whatever their investment was. If a third party or someone at that auction makes a bid on the property for what you're owed, if not more, then you get paid off in full and you get your money and you walk away and you keep the interest along the way as well.
Sure. And can I know what is the historical default rate for trustee investing?
That is a loaded question, unfortunately, because there's many forms of default, whether it's you missed your first payment,
actually,
whether it's you're 10 days late, but you're still in your grace period, whether you have an NOD on file, whether you don't, whether you went to publication, whether you went to sale, but it sold, so you got paid off. So what we track to keep things simple is REOs, basically, meaning a property goes through the entire process, it goes to sale, and then reverts back to our lender. Typically, I want to say it was last year, the year before. I believe we originated around 1,000 loans. We were servicing roughly 1,700 loans in total, and I want to say like 6 properties reverted. So it's a very low number. It's rare, but that again also goes with market fluctuations. There might be markets where there's more. There might be markets where there's less. Like everything, it goes in waves. Like the stock market goes up and down, real estate values go up and down, defaults go up and down. It just depends.
Yeah, got it. And I still want to ask this question, but you have already answered in a really detailed way. But like when investor, they want to get a sense of how risky is trustee investing. Like, of course, when it comes to like stock market or bond, everybody has a sense. But when it comes to trustee investing, like how would you answer this question? Like how safe or how risky is trustee investing? Like quickly to the investor.
I would say it depends on what they're buying. There's all sorts of different loans you can buy. So when you're buying a trustee, you can buy a first position loan, and maybe it's at 10% loan to value, meaning you're letting them borrow $100,000 on a property worth $1 million. In the business, you would call that kind of a no-brainer, right? Because they're not going to lose $900,000 in equity. So that is one that some would consider, quote unquote, safe, if you're going to use that term for investments. Now, there's other investors that are in the business that understand the process, and they want to buy loans most would consider risk on the riskier side. Perhaps it's a second trustee, meaning you're in second position on title behind the first. And the loan to value could be much higher. Maybe they're up at 65, 70% loan to value. Maybe it's 60% loan to value, whatever it is. It depends on the investor, and it depends on what your goals are. If you're an investor who's relatively new, or you're on the safer side and you want to be a little more conservative, then you're going to look for those more conservative loans. You're not going to go buy a risky loan. And so that's kind of the difference. I will say, if an investor came to me and said, is this a relatively secure type of investing? I would say it depends on what your prerogative is. If you buy more secure loans, then you're going to have a much more secure investment.
So is there any other parts about trustee investing that is really worth mentioning that I didn't? You want to bring it up to the audience?
Yeah, I mean, I would say when you're looking at trustee investing, the idea is you really want to go into it with a sense of what you're looking to gain from it. And I say that because you don't want to go in blind and say, I just want to invest in trustees, because you don't know what you're investing in at that point. Do you want to invest in a mortgage fund? Do you want to invest in a typical trustee model, which is like what we do? Do you want to stick to residential? Do you want to look at commercial? Like what kind of collateral are you looking for on that return as well, or on that investment as well? And part of that is just really calling and having the conversation, saying, hey, I'm new to this, but what you said intrigued me, or I've seen you around, I'm curious, what is trustee investing? How do I get started in it? And that's really that conversation that we have with the investor from there. And it's usually me in our office, and we get on the phone and we go through kind of what their goals are and what they're looking for. And from there, we can kind of tailor really a strategic kind of like process for them moving forward, as far as, okay, you're newer to this. Let's find you a first trustee. Let's find you a lower loan to value deal. Let's find something that's local to you on a residential tract house with a seasoned borrower, or relatively good credit on a borrower, that kind of thing. To really take a lot of that edge off. And once they get their feet wet and understand it, then they can start to broaden their horizons and look at other things. The other thing with trustee investing is there is sort of a limit to entry, I guess you could say, because it's not a situation where you can say, I want to invest $300 and get started. Typically, I say the minimum to invest is around $30,000, maybe $50,000, somewhere in that ballpark. So it's not something that is really available to the masses for that reason. But once you have that kind of that nest egg built up and you can start to do it, it's a good vehicle to kind of add into your portfolio.
I see. And I want to talk about Val-Chris Investments as well. So. Yeah. And we all know that this market, the finance market, the money market is a competitive place. Everybody knows that. And Val-Chris Investment has been there for 45 years already, right? Yeah. And what do you think is, and I consider that as a success. So what do you think are the core drivers behind your firm's success so far?
I would say reliability and reputation over the years has been a huge one. I joined the firm in '09, and even at that point, it had been around for obviously a long time, and it had been doing very well. We were known in the industry as a reputable firm that funds deals quickly, that investors have a good experience with and can rely on. And I think we've been continuing that same idea. That's kind of our goal in the marketplace is, be the firm that everyone knows. I get calls all the time of other brokers and other lenders saying like, I see your guys' name everywhere. It's always on title on properties because you guys are doing everything. And I'm like, great, that's music to my ears. The more people see me, the better. Like, that makes me happy. And I think when you do that, it's almost like a household name in our industry. And our industry is small. I say it's weird and niche because it's not something that everyone knows about.
Oh, yeah.
But within the industry, I think it's important to have a good, reputable name because it gets around quickly if it's not, because it is so small and niche that, bad behavior gets noticed fast. And I try and make sure that everything we do is the best possible and that we're good at it and everyone has a good experience along the way.
Yeah. And I wonder what kind of culture you guys have at Val-Chris Investment?
Small business culture, I would say is the best way to put it. It's not a big corporate environment. We have, I think, about 18 employees right now, if I had to kind of guess off the top of my head. And everyone is very close for the most part. I mean, everyone argues as if they're brother and sister sometimes because we see each other constantly. But as a whole, we try and have fun. And, we do office lunches, all the usual stuff once a week that we provide, and just showing some appreciation to the employees as much as we possibly can.
Do you guys even drink together, partying together?
Yes, when possible. Yeah, for those that do partake, yes.
That's great.
Yeah.
So you also mentioned about growth. So what is growth strategy you guys have?
Growth strategy within our, again, weird niche market is different, I think, than most markets because it's not a product that scales easily. Figure it's not something that I can just go online and say, okay, I'm going to start shipping to all 50 states. It's something where I need to be able to identify a market that I can lend in, and then I need to identify the investors that want to lend in that market. Because again, I'm the middleman essentially when it comes to this. I'm not going into that market and saying, I'm going to provide all the capital for all these guys myself. The capital is provided by individuals like you and individuals like me. So if I'm looking at growth, I'm saying, okay, number one is licensing and compliance. What states can we lend in with the licensing we have, or what licensing do I need in order to do so? Once I've identified those markets, it's, okay, I identified that market and I can lend there, but is there really a desire from the investor standpoint? Is there a need for them to want to buy those loans? Because if I can go lend and I say, borrower, I'm going to give you a loan on this property, but no investor wants to buy it, what am I doing? There's no point. And so the growth aspect really became understanding what investors were looking for and what borrowers needed, and then really putting those two things together. So we started looking at high growth states. We started looking at states that were more lender friendly and allowed us to participate in their state without jumping through a whole bunch of state licensing guidelines that were complete nonsense. And then once we did that, it's educating the investors, making sure they know the market that these loans are in, making sure that they understand the states and the different state guidelines that we're following and why. And then from there, it's really just marketing and understanding, what it is that borrower is looking for and how can we supply it to them. Are the rates different in those states?
Yep.
Are the terms different in those states? And then from there, it's just marrying those things together.
And how many states currently do you guys have operating?
Right now, we're in 9 states.
It's California?
California, Arizona, Nevada, Texas, Florida, Oklahoma, Colorado, Washington, and Hawaii.
Okay, and which states is bringing the most portion of the revenue?
Yeah, California for sure.
California.
I mean, we're based here. We've been here the entire time. This is our flagship office. Our only in physical office. And so majority of our loans are here in California. I would say the other states kind of close second are going to be Florida, Arizona, somewhere in there. But we have I think we fund probably, let's see, funding I wouldn't know. I know ongoing servicing is roughly 15 to 20 million ongoing as far as loans that we're servicing in other states, which is a great kind of extra piece to the business. And frankly, if I wanted to continue to pursue growth, I would probably look at other states or growing our footprint in the states that we're already in.
And when you expand to a new state, what is the process like? Do you hire someone there first, or? Of
A
course,
lot of
the
due
paperwork,
diligence.
the documentations, those are the first thing. And
Yeah.
once you're kind of legit to operate in that states, what do you do?
The first thing is going to be looking at the market trends and understanding what the values are doing, understanding the areas that I want to lend in, knowing, not what I want to lend in, but knowing what our investors are going to want to lend in. Investors are looking for properties that are typical tract style houses for the most part, very cookie cutter type places. Very rural or very unique, overly built properties are tough to lend on in general, especially when you're selling them off to a private investor, someone who's looking at that collateral and saying, do I want to own that loan? Do I, want to deal with this if that borrower doesn't make payments for whatever reason? So I would say when we move into other states, it's really trying to marry all those things together and talking to people that are on the ground, understanding what they're dealing with out there, looking at what other private money lenders that are based in those states are doing. And then once you kind of have all that in mind, you start to kind of, you offer some products and you see, what fits. And there's always going to be a little back and forth in the beginning to understand kind of where that sweet spot is. But you tend to find it pretty quickly, especially when you have a couple different people really working on it and focusing on that growth.
Yeah, I see. And I know that trusted investing is kind of like, as you mentioned, a niche market. And it's not that trendy or popular or well-known as other kind of investment, like just, for example, stock market. So why is that? And when it comes to like, when you're looking for customers, do you always like educate them first?
Yeah, I mean, it's funny. We don't even actually market for investors. It's all referral based at this point, which is great. I mean, that's a good problem to have. But most of the calls I get are because they heard about us from another investor, a friend of theirs, someone like that who said, hey, call these guys. I've been buying loans from them for a while now. That is, and then from there, it's the education piece. It's making sure they understand what they're doing. When I say that, it's really just talking to them, like I said earlier, understanding their goals, what they're looking for, and making sure that they understand what their goals are in this case. What I don't want is a brand new investor who doesn't know what they're doing, putting their money into a deal that I would say, no, that's for a more seasoned investor probably if you're looking at that. So we try and kind of offer some guidance along the way, and that's kind of it.
And how do you retain a customer? Because I think most investment firms oftentimes find it hard to retain a customer. Like how do you retain? Like how do you manage the relationship with the clients? Yeah,
I would say offering the best service possible is really what it comes down to. In my office, I joke, I always say put a good taste in their mouth. Like when they're done talking to you, make sure that they walk away from that conversation happy. It's not foolproof. Obviously, there's happy customers, mad customers. I mean, it is what it is. You do the best you can across the board, but you can't control everything. And so I rely on my staff quite a bit to offer that good experience to our investors. Especially the more stuff I do is a managerial side of things. I have to rely on a lot of other people to do the things I used to do, and that takes some time and getting used to. But we have a very competent staff, and they're very good at what they do. And I think just offering that level of service that the investor is looking for and come to understand is normal, is kind of how you keep the referrals coming and how you keep them talking positively about you.
Yeah, and what kind of communication style that you guys have with the clients? So are you like trying to talk to them as a friend because it makes you guys closer, or do you want to just keep yourself like as professional as you can? What type of like communication style you guys have with the clients?
Yeah, that's a good question. I mean, first and foremost, we're a fiduciary when it comes to their investments. So when we're talking to an investor, our goal is to have them invest their money in trust deeds, and we're going to do the best we can to kind of be, the caregiver of those investments. At the end of the day, it's out of our hands what the borrower does, right? And so we rely on the appraisal and the collateral to make sure that there's plenty of security there if the borrower is a pain in the butt. But with the relationship with the investors, I think it's it's a fine line between making sure you're friendly, making sure it's someone you want to talk to, and making sure that you're there to ask questions and kind of be a little more candid with a lot of the conversations, because they might not be in this business. They might be an engineer in something, and they're buying trusted investments, so they're relying on me to kind of get that info. And so it's there's a lot of just very down to earth conversations of just understanding kind of what they're buying and why they're understanding what they're looking for in that investment, and then asking from us the basics and kind of how it works. And so I would say it's a fine line. We're not a stuffy Wall Street stock trading firm, but we're also not their next door neighbor. Drinking a beer with them on a Friday night. So it's a fine line between making them feel comfortable while also making sure that that it's a professional atmosphere.
I see.
Yeah.
All right. Actually, that's all the question we have about the business strategy.
Okay.
So let's talk about the market overall. So that tariffs is being a really hot topic recently. And I know it has gone down from like 145% to 30% because the dialogue that the Chinese officials and the American officials had at Geneva. And I wonder, does tariff, has any impact on your industry? I don't feel like, but
no, not that I've seen so far. I know that it's affected a lot of the high-end sales, high-end home sales. So I saw a Wall Street Journal article the other day of people who were in escrow on 20, 30, $40 million properties in Miami. A lot of them are pulling out of escrow because they're waiting to see what's going to happen with the economy.
Yeah.
The tariffs, I'm not an economist. I have no idea what's going to happen with those things. But I will say, thankfully, with us, it hasn't had a huge impact.
Nice.
For us, really, our market is based on real estate values, kind of where those are, and also access to capital. How much capital is in the market to place. If investors aren't looking to invest, it's much harder to get a loan. If there's plenty of investors looking to invest, then it's easier to lend out that money. So it's a give and take.
Yeah, and since you guys offer real estate loans, right? So what is your stand on the market valuation of the real estate? A lot of people say that houses are getting extremely expensive and it is overvalued, especially houses in Irvine. I think the average house's price here is $1 million US.
That sounds about right based on what I'm seeing. I'm not sure, but I wouldn't be shocked.
Yeah, I wouldn't be shocked. Right?
Yeah,
so like, what is your stand on this? Do you think it's overvalued or it is at par? Like, what is your stand?
I think every generation kind of has a new plateau or a new base. And, I look at values in the 70s and 80s, and I'm from Lake Forest, and the house I grew up in, I think sold for like $70,000 in, the 70s, whenever it was bought, versus I looked the other day and it's 1.1 million right now. And so I think things are overpriced until it becomes standard, and then it's the norm. And I think right now we're kind of seeing a new norm come into play.
Say that again. Things will be overpriced until
things are overpriced until you get used to it. And then it's the norm. Think of gas prices. It was normal to see $3.50 a gallon a couple of years ago. Now it's normal to see $5 a gallon. I doubt we're going to be seeing $3.50 a gallon in California for a long time, if ever. And I think same thing with property values. If you have a house in Irvine and the average price is $1 million and it's hard to find a house, odds are if that price drops to $900,000, there's going to be a bidding war and it'll go right back up to roughly $1 million or close to where it was.
Yeah.
I think real estate is one of the true indicators of supply and demand, because there's typically a finite supply and the demand fluctuates based on that price, and the prices follow that demand. So again, not an economist. I can't comment, I think, really on where the markets are going. I would say right now what I'm seeing is values are pretty steady. I would say after COVID, we had a massive boost that everyone saw. There was a year or two, I would say the last 18 months has kind of shown some wobbling as far as where the prices were, fluctuating up and down 5-10% depending on the market.
Yeah.
But right now as a whole, especially in areas like Orange County, San Diego County, the more desirable areas, quote unquote, for real estate, it's pretty steady, and I don't see much fluctuations coming.
Got you. And my next question is, do you mind sharing your personal allocation on the investment? What is your portfolio like? How do you invest?
My portfolio, being in the business, I would say I'm probably heavier on trust deeds than I am anything else. But that's because I'm in the business. I understand it. I appreciate it. I feel very comfortable in it.
Like, do you have like 80% or like more than
I would
half?
say I'm probably I'm probably about 80% in trust deeds maybe about 70% in trust deeds.
70%.
And then obviously with stocks, real estate, and other ownership interests, things like that. But I'm much more heavily into trust deed investing, and my ultimate goal is to have it so that my trust deed passive income offsets my monthly liabilities.
Yeah.
Right. And so I think if everyone can get to that point, then you can do whatever you want, right? Because you can wake up and you're making enough money off your investments and your money's working for you. You're not worried about having to go to a day job to pay the bills. And so
100% right.
Yeah, so that's what I look at the stock market for me as kind of a long-term growth. If I'm buying stocks, I'm not buying them to sell when they go up 10%. I'm buying them to then sell when I'm 65, 70 years old, what have you. if I have to. 401k, same situation. It's for that long term. But for me right now, buying trust deeds offers that monthly income so that I can keep building my investment portfolio now. And maybe one day I can stop what I'm doing because I decide, not because I have to or because I want to. It's just because at that point I'm done. And I think that's the ultimate goal of trust deed investing, is building up that passive income to kind of offset your daily liabilities.
All right. Actually, that's the other question we have, but I do have the last one, and it's specifically for you.
Okay.
So at this stage of your life, what is the most important life lesson you have learned so far? And you want to share it with the audience?
Important lesson, I would say at this point in my life, is time is money, is really what it comes down to. I think when we're younger, we spend all of our time trying to work, get ahead, which you need to do when you're younger, in your younger years, before you have the family and before you have the kids. Being kind of in the middle part of my career right now, I think a big aspect for me is, I have the young children, I have my wife that I love, I have my family that I want to be around constantly. And so it's finding that balance. And it's kind of understanding that, and I think why trust deed investing resonates with me so much is that offers you the ability to have like real freedom in the future, because
it's passive.
It's completely passive, right?
Yeah.
And so as you build that nest egg and as you buy more trust deeds and as you get that monthly income greater, it starts to give you time. And it almost gives you that time back that you paid in the beginning to get to where you are in your career, to get that money that you have now to invest in. And I think that's the biggest lesson right now is you get one life. And at the end of the day, you want to have that time and you want to use that time wisely. And the more time you have, I think the wealthier you are really in life in general.
Great lesson. Thank you for that.
Yeah.
And if our audience or any investors and borrowers want to find more information about you or the Val-Chris investment firm, where can they get it?
You can email me, Jeff at Val-Chris Investments, Jeff at val-chris.com. Our website is just val-chris.com as well. And hopefully you can put this on the podcast link stuff.
Yes.
We're based here in Irvine, and you can find us on LinkedIn, on Facebook, on Instagram, online.
Great.
All sorts of places.
Great. Thank you.
Yeah. Thank you.